Right, on in the last class, if we recall, we had covered the entire taxation issues of sole proprietorships and one-person companies and Section 8 companies and societies and the relative advantages and disadvantages of all these entities. Today, the class is basically on two aspects. One is the taxation of limited liability partnerships. That is one. The other aspect that we will be discussing is the taxation requirements in the context of companies, especially and specifically in the context of shares. When shares have to be issued, when shares have to be issued at a premium, etc. So to start with limited liability partnership, I think it is important to first understand that what is the definition of partnership. The definition of partnership can be seen in Section 4 of the Indian Partnership Act 1932, which defines partnership as a relationship between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. That is the definition of partnership, which is there in Section 4 of the Indian Partnership Act 1932. The definitions which are relevant in the context of today's discussion can be found in the Limited Liability Partnership Act of 2008. Now, for instance, Section 2N, N as in Nepal, defines a limited liability partnership as a partnership formed and registered under this act. This is the simple definition of LLP which is given. Then the other important definition is in Section 2O of the LLP Act. That is the definition of limited liability partnership agreement, which means basically any written agreement between the partners of the LLP or between the limited liability partnership and its partners, which determines the mutual rights and duties of the partners and their rights and duties in relation to that LLP. The other definition can be found in Section 2Q of the LLP Act, which is basically the definition of partner. So these definitions under the LLP Act, so it is very important, as law people, we have to understand that the definitions, whatever we see in the Income Tax Act, it always has to be read with the parent legislation, whichever is dealing with the whatever kind of organization or entity that we are dealing with. Now, once we understand the definitions which are there under the Partnership Act as also the LLP Act, now if you look at the provisions of the Income Tax Act. The Income Tax Act, the relevant provision is Section 2, Clause 23 of the Income Tax Act, where LLP is covered in three ways, basically. One is the definition of firm, which includes an LLP as defined under the LLP Act of 2008, that is 23.1. 23.2 says the definition of partner, which includes the partner of an LLP as defined in the LLP Act of 2008. And the third aspect is the definition of partnership, which includes a limited liability partnership as defined in the Limited Liability Partnership Act of 2008. So this is how, the legal interpretation as to how the definitions of the under the LLP Act will also be applicable in the Income Tax Act, and how the provisions of the Income Tax Act will be applicable in the context of LLPs. This is the, the step-by-step, this is how you have to proceed. Now, let us first understand the overview of how the Income Tax Act deals with LLPs and what are the taxation principles when it comes to LLPs. Now, first of all, a firm that is an LLP is always taxed as a separate entity. Okay, it is a separate entity from that of its members. Whoever partners are there, whichever partners are there, they file their own income tax return, which is separate from that of an LLP. Further, whatever partner share is there in the income of a firm, that is not chargeable to tax in the hands of the partners, because the firm is already paying for it. So that way it is covered. But specifically what I would want to discuss today is the entire concept of remuneration. Basically, any salary, bonus, commission, or remuneration which is payable to the partners is primarily allowed as a deduction to the firm. However, it is not that there is a blanket deduction that you enhance your remuneration so much that you can circumvent whatever tax the LLP has to pay. It doesn't work that way. There are certain guidelines, there are certain provisions of law which have to be followed. The deduction is the whatever deduction has to be there. It is subject to whatever is allowed in the hands of the partner, subject to what is allowed in the provisions of the Income Tax Act. The next part is that when it comes to the payment of interest to any partner, the firm can claim deduction of such interest from its total income. However, there is a maximum rate which has been stipulated, and the maximum rate at which the interest can be allowed to a partner is 12% per annum. The amount of interest allowed as deduction in the hands of the firm is taxable in the hands of the partner. Now, apart from whatever, this is with regard to the income and the remuneration aspect, but then there are certain other, provisions also. There are certain other payments also, there are certain other taxes which are also payable by the LLP, which basically includes a 30% surcharge at the rate of 12% of income tax is applicable if the income of the firm is more than 1 crore. Apart from that, what we have already covered earlier, the health and education cess will also be applicable. Now, practically speaking, the income tax rate around the approximate income tax rate which comes if the income of the firm is not more than 1 crore is 31.2%. If the income is more than 1 crore of the firm, then the effective rate comes to around 34.944%, which is basically including the 30%, the surcharge, the health and education cess, etc. The idea behind giving you this summary was to give you an overview and an overarching, view of how the Income Tax Act actually taxes the LLPs. Now, but there are two sections which are very important when we talk about the LLP and their taxation. And those two sections have to be fulfilled if the LLP has to be taxed. And more importantly, if the deductions with respect to remunerations which have been given out to partners have to be allowed in respect of the LLP. Now that is covered in one is section 184 and the other section is section 40 clause B. Now there are certain requirements which are mentioned in the in section 184 of the Income Tax Act. First of all, the act says the firm must be evidenced by an instrument. What does it mean? It means that there has to be a partnership deed, which is obviously very important, but there also have to be other documents which have to be executed, which satisfy the definition of documents, which is evidencing, and instruments which are evidencing the existence of the partnership firm. Even under the LLP Act, the entire concept of LLP is that it is a limited liability partnership. Had it been the earlier model, then just an agreement suffices. But especially in the context of an LLP, there are other documents also which have to be executed. So that is the principal requirement of section 184 of the Income Tax Act. The other aspect which is required is that the individual shares of the partners must be specified in the instrument or the partnership deed. The partnership deed or the instrument that has to have in full clarity whatever individual shares of partners are there. Otherwise, it will be very difficult. Without this, basically, these are all mandatory provisions to claim the deduction for remuneration. If any of this is not there, then you will not be able to claim the deduction in respect of remuneration. This, by the way, this is as important for lawyers as it is for non-lawyers, because I can tell you from my personal, experience, because our firm is also set up in the form of a partnership. But because we are able to claim whatever remuneration is given out to partners, it is because of all these conditions which have been fulfilled. So it is very important for lawyers. The third aspect which is very important is that the certified copy of the instrument or the partnership deed should be submitted along with the return of income for the first year. But practically, what happens is that if you look at the form ITR 5, which is filed for income tax returns, it really does not have the provision for uploading of any documents. Hence, normally the practice is to keep the certified copy and all ready. If it is required by the assessing officer, then you submit. The other aspect is that whenever there is a reconstitution of the firm or the change in the in the profit sharing ratio, in those times you have to revise the instrument of partnership deed. Every time there is this kind of a situation arising, you have to modify and amend the provisions of the partnership deed, because as I said, the first point is very clear that it has to have very clearly whatever is the share which is being given out, as also what is the remuneration which has to be paid. Without that, it's not possible for you to claim the deductions. These are the requirements which are there under section 184 of the Income Tax Act for claiming deductions with respect to remuneration which are given out to partners. But now the other aspect which has to be complied with is section 40 clause B of the Income Tax Act. Section 40 clause B says that first, the remuneration has to be paid only to a working partner. You can't have a partner who is, there are different kinds of partners, as I'm sure you all know by now. There can be a sleeping partner, there can be a working partner. So point is that the deductions and the remuneration can be paid only to a working partner. That is somebody who is actively engaged in conducting the affairs of the firm. The idea is that you should not end up having a partnership for the sake of having a partnership, and then you fictitiously show that somebody is there as a partner and then X amount is being paid to that partner, and hence that remuneration, whatever is paid out, should be deducted from the income of the LLP. It can be deducted only if there is a working partner. The partner has to be involved actively in the day-to-day affairs and in conducting the affairs of the firm. The other aspect is that the same thing which was there earlier when 184 also says that the income on the interest of the partners has to be clearly specified in the partnership deed. Similarly, 40 clause B says that whatever remuneration is there, that has to be authorized by the partner's deed, and it should be paid according to the terms of the partnership deed. This is point number 2. Third aspect is that the remuneration cannot be pertaining to a period prior to the partnership deed. So basically, when there is a partnership deed, you can't have some stipulation in the partnership deed with regard to remuneration, which is of a period even before the time this clause was inserted in the partnership deed. Basically, the legal principle is that the amendments or the remuneration clause which is inserted in the partnership deed cannot be applied with retrospective effect. That is the principle and the requirement under 40B. Then there are certain other aspects which are, given under 40B. For instance, there are certain limits which are basically prescribed. So remuneration basically, as I was saying earlier, that remuneration has to be within a certain limit. And this is the limit which the section prescribes, which says that remuneration should not exceed the permissible limit given below. On the first 3 lakh of book profit, or in the case of loss, 1,50,000 or 90% of book profit, whichever is more. Secondly, on the balance of book profit, 60% of the book profit. This is the stipulation which is there. So whenever you have to determine how much remuneration is to be paid, who has to be paid the remuneration, you also have to do this calculation of book profit. Now, book profit, it is a slightly technical concept of book profit, but the formula is very simple. Book profit essentially means that once you have the profit and loss account of the firm and you find out the net profit of the firm from the profit and loss account, then you apply the adjustments which are there from sections 28 to 44, capital D, capital B. Once you do that, the third step is you add the remuneration to partners if debited to the profit and loss account. What you get finally is what is known as the book profit. However, there are certain incomes which do not fall within the definition of book profit. For instance, income which is chargeable under the head of income from house property cannot fall within the definition of book profit. Capital gains, then income from other sources, these do not fall within the definition of book profit. Then there are other things such as brought forward business losses, they will not be deducted from the book profit. Thirdly, when there are deductions which are there, for instance, sections 80C to 80U, we had covered 80G, we had covered in one of the discussions earlier. They will have to be ignored while we are computing book profit. So, point being that there are 3-4 aspects which I wanted to discuss in this, which I have covered. And because these are things which are very relevant for anybody in any kind of business if they have to start, because people are ending up forming partnerships of all kinds, and they are thinking that partnerships are just to sort of, avoid payment of tax, which will otherwise be liable. But that is not so. The law does not allow you to have a partnership just for the sake of saving tax. It's not a tax saving instrument. The idea behind the partnership is that you have to have a working partner, and the remuneration, etc., which are there, has to be mentioned in the partnership deed. Only then will you be allowed to claim the deduction for remuneration from the income of the LLP. Third aspect, which is very important, is that the partnership deed has to, include everything, whatever remuneration clauses are there, the timeline, the quantum, etc. And the remuneration has to be within the limits which are stipulated in the law. Now, and lastly, very important, that the whatever filings, etc., have to be carried out with regard to the LLP, they have to be updated each time there is a change in the profit sharing ratio. There cannot be any retrospective effect of LLP remuneration. Practically, what happens is that there are a lot of firms and partnership firms doing all kinds of business. They basically, what they do is they calculate whatever incomes have come in the financial year, and at the end of the financial year, they amend and put in the partnership deed that the remuneration which was payable in this entire period is X amount of money, and hence that will be deductible as a remuneration from the income of the LLP. The law is very clear that these amendments cannot apply with retrospective effect. This is broadly how remuneration of partners is dealt with under the concept of LLPs. And by the way, similar concept in relation to partnership, regular partnerships also, which are basically not LLPs. The distinction also, definition distinction, I have already discussed. The second part that I wanted to discuss with regard to your partnerships is basically in the context of the capital which is contributed by the partners in a firm. Now, when we talk about the capital which is contributed by partners in a firm, that basically deals with what is known as, you would have heard if anybody has basically dealt with any kind of property transactions, etc. And that is basically what is known as a capital gain tax. Now, if we have to look at the kind of capital contributions which can be done, what are the relations, what are the different kinds of transactions you can have between a partner and an LLP. So basically, capital contribution is not just about the money which is contributed in the firm. Capital is obviously, share capital is what? It is money, granted. But when we talk about capital in the context of capital, contributed by partners to a firm, or when partners get something from the firm, which is basically the capital which they get from the firm. So capital in that sense is used in a wider spectrum. It is not just about money, but it is also other capital assets, for instance, land, machinery, buildings, etc. But the point is, the moment you deal with capital contribution of a firm, and over here I would like to talk about contribution basically when happens at the time of capital contribution as also at the time of dissolution of the firm. These two aspects that I would want to deal with. But to understand capital contribution, you have to go two steps back. And that is the entire discussion of capital gains, which I understand it is slightly, complicated, but then it is not that complicated also once you understand the funda which is there and the formula which is prescribed, which is standard. Now, the first provision which you have to, understand is Section 2, Clause 14. Section 2, Clause 14 of the Income Tax Act, which deals with the capital asset. There, the definition of capital asset is divided. Basically, there is a positive list and there is a negative list, where capital assets means any property of any kind, whether fixed or circulating, movable or immovable, tangible or intangible. And then there is a list of assets which are mentioned, for instance, rights in relation to an Indian company, etc. What it does not include is things such as stock in trade, personal effects, that is movable assets, agricultural land in a rural area in India. This is what capital assets actually mean. Then there are two kinds of capital assets. One can be a short-term capital asset. The other is a long-term capital asset. So short-term capital asset is any capital asset which is held by an SSE for not more than 36 months immediately prior to its date of transfer. This is the definition of a short-term capital asset which is mentioned. However, if I end up holding it for more than 36 months prior to my date of transfer, then it becomes a long-term capital asset in my hand. For instance, if there is a piece of land, I buy it in 2023, and then if I sell it in 2025, then it will remain a short-term capital assets. Whereas if I sell it after 36 months, then it will become a long-term capital asset. Then there are other nuances also, but I'm just giving you a broad overview so that you understand what happens when there is a capital contribution or a capital removal of from the partnership firm by the partner. The other concept which is very important is the transfer of a capital asset, which is basically defined in Section 2, Clause 47 of the Income Tax Act, which basically means any sale, exchange, or relinquishment of the asset or the extinguishment of any rights therein or the compulsory acquisition thereof under any law. Now, the next part, which is very important, is that how does this transfer happen? I'm sure if any of you have done your Transfer Property Act, etc., it basically talks about registration of instruments. When there is an immovable property which is there, till the conveyance deed is executed or registered, only then we say that the property has actually been transferred. Without the registration or without the execution, it does not mean that the property has been transferred. Now, the other aspect which is very important is Section 48, which is capital gains and the computation of capital gains. It is in this context that what I was talking about, the distinction between a short-term capital asset and a long-term capital asset, and that is a period of holding basically, which is 36 months. If you hold it till 36 months, it is short-term. Beyond 36 months, it is long-term. It is in that context that this is important. And which this entire formula of calculation of capital gains is primarily provided in Section 48. Over here, this talks about different steps basically which are there for the computation of capital gains. Over here, there are basically different provisions which are retracted: Section 48, 112A, 50B, etc. Now, another definition, you can make a note of it, is under Section 48 of the Income Tax Act, which basically talks about the full value of consideration. Then there are three concepts which are very important, which is expenditure on transfer, cost of acquisition, as also cost of improvement. Now, cost of acquisition, please understand, it is the value for which it was acquired by the SSA. As simple as that. There is nothing more to it. On the other hand, if you acquire a land and then you or a building and then you try to improve it by making some additions, repairs, etc., that falls under the definition of cost of improvement. The reason why these two definitions are important is to ascertain what is known as the indexed cost of acquisition. And the formula for the indexed cost of acquisition is cost of acquisition divided by the cost inflation index for the year in which asset was first held by the SSE, or 2001 to 2002, whichever is earlier, multiplied by the cost inflation index for the year in which the asset is transferred. Now, I'll just come to the point when we talk about this transfer of capital asset by a partner to a firm. The capital asset, the definition I've already covered, transfer I've already talked about. A capital asset is transferred by a partner to his partnership firm by way of his capital contribution. It is treated as a transfer and capital gain will be taxable in the hands of the partner. The amount recorded in the books of account is taken as the full value of consideration. Now, this rule is applicable when a member transfers the capital assets to his association of persons or the body of individuals. So let me repeat. A capital asset is transferred by a partner to his firm by way of his capital contribution. For instance, if there is a house property which I bring into my law firm, that will be called as my capital contribution. Say, for instance, the cost of the fair market value of the house is 20 lakh at the time at which it is being brought into the partnership. However, basically the amount which is recorded in the firm is of 18 lakh. So then there is an advantage of 2 lakh which is given out. The other aspect is that you have to ascertain that what was the cost at which the house was purchased when I had purchased it. So these 2-3 values are then ascertained to then calculate that what is the capital gain which is applicable. This capital gain will be taxable. That tax will have to be paid in the hands of the partner. This is what happens when there is a transfer of capital asset by a partner to a firm. Whereas there are instances where, say, suppose, there is a dissolution of the partnership or there is a retirement. And then when there is a retirement of somebody, then it obviously leads to a change in the partnership deed, because then there are new partners which are there, or the existing partners. Basically, the profit sharing ratio which is there, say, for instance, earlier it was 2:3:1. Then if the person who held 2 goes, then this profit sharing ratio might remain the same or might change. But the net effect of all this will be that the percentage of holding will obviously go up of people who are continuing over there. This is what happens when there is a retirement or a dissolution of the firm. Similarly, when a retirement of a partner. Now, similar is a situation when a dissolution happens. Of course, in the case of a dissolution, the partnership firm is no longer in existence. But the question then remains that if there is a capital asset which is there and it has to go back to the partner, then what happens? So that has been covered under Section 9 capital B and Section 45 Clause 4 of the Income Tax Act. This was basically substituted by the Finance Act of 2021 with effect from 2021 to 2022. For 9B and 45.4, the important definitions which are there are, you can make a note of specified entity, specified person, reconstitution of specified entity, self-generating goodwill, etc. Now, the method of calculation of capital gain is provided under 45 clause 4 of the Income Tax Act, which basically means the formula is value of any money received by the specified person from the specified entity on the date of such receipt, plus the fair market value of the capital asset received by the specified person from the specified entity on the date of such receipt, minus the amount of balance in the capital account represented in any manner of the specified person in the books of accounts of the specified entity at the time of its reconstitution. Now, I understand it is technical, but tax is all about the formula which has to be adopted, and this understanding of formula becomes very important, because once you compute this, then you can understand how much tax is to be paid, and if there are any means of actually saving tax legitimately. But practically speaking, when it comes to capital gains, frankly, there is no way of saving tax, because everything is documented, everything is registered, and there is no great interpretation of the law which is involved. There is a fixed formula for ascertaining fair market value. There is a fixed formula for ascertaining capital gains. The property, if there is a property, it has been purchased, it is already there in the registry. And as per what I had already discussed, effective transfer of any property can only happen once uh, once the instrument, whatever has been executed, that is registered. Without that, it is very difficult to say that your property has, and that is under the Transfer of Property Act. So if without that, it is very difficult to say that the property has actually been transferred. So when all this is happening at multiple levels, there is a check which is there on the value of the property, and there is no great interpretation which is involved. Hence, that you have to look at the formula which is there and then see how it is that you have to pay the tax. So this is when it comes to taxation of LLP. What happens when capital asset is introduced? What happens when somebody retires from the firm? What happens when there is a dissolution of the partnership and the capital asset goes back from the partnership to the partner? Then the other aspect that we were dealing with, which is more relevant on a day-to-day basis, is that of remuneration, because quite often we are finding in practicality a lot of instances where partnerships are being made with the assumption that you can just make a partnership, and then because of some calculation, what you don't have to pay as much tax. This is how this also functions. For instance, when you talk about taxation of individuals, there are different brackets which are there. One is for males who are below the age of 60. Then there is another category for women. Then there is another category for 60 years plus. Then there is another then there are all these different categories which are there. What happens is, more often than not, people feel that you can just get one person who is below 60 who will do most of the work. You will have another senior citizen who is above 60 who will just be there on paper, and then you will have another lady who's there, because then her tax payable brackets will be less than what is there for the males. And then as per their calculation, the LLP will then claim deduction under different heads, and then the others will just get remuneration. And the remuneration will be fixed in such a manner that it will be just less than the tax bracket. So only women get just minimal remuneration. The senior citizen gets minimal remuneration. Major remuneration goes to the person who's actually working. And all this leads to a reduction in the tax which is finally paid. This is out and out tax evasion, because the law is very clear. You can't structure the LLP or a partnership in such a way just to evade tax. You can get all the deductions that you want to, but only for people who are actually working. It can't be for people who are there for the sake of it, number one. And number two, whatever document is there should be recorded. It should record clearly what the partnership remuneration requirements are and what are the timelines for payout of the remuneration. And this ideally has to be done in advance, and the same document has to be registered with the income tax department. Of course, practically, as I said, ITR, that form, it makes it slightly difficult because it really doesn't have the system to upload. But point is that it's better to keep it ready. And the other way of bringing in more sanctity to the whole partnership remuneration clause is by actually registering the partnership deed as per the local requirements of the registration of partnership deeds. This is with regard to taxation of LLPs. Now, the next part which I wanted to cover in today's discussion is that of companies and a related concept which is there in terms of taxation of shares and how the taxes are issued and how the taxes are imposed whenever there are shares which have to be issued. This is especially relevant in the context of startups, because in startups, what happens is you have a lot of these founders and investors and young people who come together to form companies. And then, so basically, in a startup transaction, there are two people. One is the startup, founder and the startup as such. The other is the investor. What happens is that whenever there are transactions where the money has to come from the investor to the startup, we find that more often than not, on the startup side, see, the investor will always be a more sophisticated person if he or she is investing hundreds of crores or even 1 crore in a startup. But a startup person does not really have a lot of idea as to what has to be done with regard to the shares. Now, one thing which people have, clarified it a lot, and that is what is to be done with regard to the management of the companies and what happens when the shares are issued, shares, the ownership is diluted, and the investor comes in. But more often than not, what is not understood is the taxation requirements which happen when it comes to shares, and what are the consequences which may arise for both the company as also the members of the company when we talk about the entire issue of issuance of shares and transfer of shares and issuance of shares at a premium. Now, in my last class, if you all recall, I had discussed the concept of dividend distribution tax. And then I had said, so the first thing that I would want to deal with is that when there is payment of dividend for shareholders, then basically what happens? Whenever there is a payment of dividend, the norm earlier there used to be the system of DDT, which was introduced, which is a dividend distribution tax. Now, that dividend distribution tax, as I said, and one of the disadvantages of companies are that it really comes and goes with different finance acts. That depends on a lot of consideration. So I'm not talking about, whether or not it is the right thing. What I am just saying is that because of there is 1%, there might be some uncertainty over the imposition of the dividend distribution tax. Now, this is especially important because there are companies who will have owners of companies, especially when there is a 1% company. So when a 1% company is there is obviously just one shareholder, but and that shareholder gets the dividend which is paid on the shares of the company. The management is done by some other company, and the owner of the shareholder of the company feels that he has ultimate control over the company and he only has to get the nominal dividend, whatever is being paid out. The problem then arises is that there is something called a dividend distribution tax, which basically taxes the dividend which is paid out at two levels, at the stage of the company as also at the stage of the shareholder. Thankfully, after assessment year 2020-2021, as I said earlier, under section the DDT which was imposed under section 115 clause O is no longer there. So that has been repealed. Finance Act 2020 has abolished, and this is as the Income Tax Department itself says, the Finance Act 2020 has abolished the DDT and moved to the more classical system of taxation, wherein dividends are still taxed. It's not that it's not taxed, but it is taxed at the hands of the shareholders or the investors. The company doesn't have to pay tax only on the distribution of dividends. So that is one. The other aspect is, uh, you know, what the definition of dividend itself. That is covered under Section 2, Clause 22 of the Income Tax Act 1961, which is again not an exhaustive, but it is more of an inclusive definition of different parts. That is distribution of accumulated profits, distribution made to shareholders on liquidation out of accumulated profits, etc., etc. The When it comes to domestic companies, in the context of DDT, they will have to pay tax, as I said, only up to this assessment year 2020-2021. They no longer have to pay. But under Section 194, they have to deduct a 10% TDS tax deduction at source, what is colloquially called, from the dividend which is distributed, but not all the time, not for just 200, 300 rupees. That is, if the aggregate amount of dividend distributed or paid during the financial year to a shareholder exceeds 5,000 rupees. Then under Section 194, the company has to deduct tax at the rate of 10%. The other part is that the taxability in the hands of shareholders. That component, as I said, that is basically whatever tax is there as per the tax bracket, the shareholder has to pay whatever amount is being received by the shareholder as a dividend. The third aspect, which is not basically, there is a distinction between a resident shareholder and a non-resident shareholder, which is there. And then there are different, requirements which have to be followed in cases of both. So point is that the law carves out a distinction between the two with regard to resident shareholders as also a non-resident shareholder. There is something, so basically these are the different kinds of taxation issues which arise when it comes to payment of dividend to companies of basically any company where there are shares, be it a one-person company or private company or a listed company. The other aspect which is important is the entire concept of what is known as bonus shares. Now, bonus shares are basically, as I said, these are, when there are existing shareholders and to them the bonus shares are issued by the company. So then what will be the taxation requirements which will be applicable? Now that taxation, for instance, if I own 1,000 shares of Reliance Industries or whatever, and then there is a bonus issuance of the shares, then the tax that I have to pay on the bonus shares is basically depending upon the duration for which I have held the bonus shares and before selling it out. That will be the criteria for determining how much tax I have to pay. It is again in this context, the earlier discussion that we were having with regard to capital gains, etc., all of that becomes relevant because the fair market value at the time of acquisition of shares and the value at which the shares have actually been sold, those two will be the determining factors to ascertain the taxability of the bonus shares. The third aspect, which is very important, is the taxability of the share premium which has been received in excess of the fair market value of the shares. That is again, see, you would have understood one thing. There is a pattern to which the shares are being, how the shares are actually being taxed. And that pattern really depends on the cost of acquisition, again, discussion on capital gains, and the cost at which it is sold, again, discussion of capital gains, and and the duration for which the asset has been held. Again, discussion on capital gains, the distinction between short-term capital gains and long-term capital gains. This is the basic, principles behind taxation of share transfers. When there is a share premium which is issued in excess of the fair market value of the shares, then what is attracted is Section 56(2) 7b, 56 clause 2 subclause 7b, which basically says that if the recipient is a company, not being a company in which the public are substantially interested, or it receives consideration for issue of shares, preference shares, or equity shares from a resident person. And thirdly, the consideration received for issue of shares exceeds the fair value of such shares. In other words, shares are issued at a premium. In these circumstances, the aggregate consideration received for such shares as exceeds the fair market value shall be chargeable to income tax in the hands of the recipient company. This is the, as I again, the principle remains the same, that if there is it is shares like any other asset. So even if it is not strictly a capital asset, but the logic one has to understand remains the same, that what is the cost at which it has been acquired versus the cost at which it has been sold, what is the net benefit which has been caused. This benefit component becomes very important, and the statute and the department tries to tax that difference which has been which is there. The third aspect, which is very important again, is the entire concept of dividend. And I'm reiterating this over here because dividend, bonus share, share transfer, share premium, all these aspects, dividend especially is something which companies are facing with again and on an again and again basis. Dividend, one aspect which is very important is the distinction with regard to the assessment years which is there, because assessment year 2020, 2021 onwards, only dividend which has been paid out is not taxable. But there are cases in which the dividends which have been paid out even before that time, for some or the other reason, the tax is not deducted or the tax is not paid to the government, etc. This advisory should always go to your client or whomever you are advising, that for that period, this exception is not applicable. So for that, the whatever tax had to be paid by them. If it has not been paid, then it is an issue. This is a broad overview of LLPs and companies and the taxation of LLPs and companies. Companies, of course, see, there's a lot more when it comes to taxation of companies, but these are the principles of taxation of companies in the specific instances what I had discussed, which is dividend, bonus shares, etc. Any doubts, any queries? I know it is complicated, which is why I have given you the section numbers also, that you please go and read the section numbers, which will again give you, an understanding of how things are calculated. I would really suggest look at the whatever discussion we had with regard to capital gains. That is extremely important, because that really helps you to understand a lot of things. The simpler part was the capital contribution by partners in a partnership, and what happens when the partnership dissolves and you have to get the capital asset back. There are fixed formula which I have mentioned. What happens in a share transfer or a share transaction is more complicated than this, and hence, but the funda, as I said, keeps on, in a way, it keeps on extending. So please read the section numbers, whatever we have discussed. Any doubts, any questions?
May I ask one question?
Yeah.
Actually, I couldn't participate last discussion, but just one question which I had from a practical perspective regarding that fair market value. So it says that if the consideration exceeds fair market value and the shares are issued, then it get taxed at the recipient company. So the more critical aspects comes about the valuation of the company at a particular point in time. Now, in your practical experience, has it come across? Because if you're doing a valuation of, let's say, a startup, the perception from a one valuer to another valuer would be changing. So in that scenario, how would the advice, because it becomes a matter of judgment, and the regulator or a taxation authority would have a benefit of an hindsight. So in that context, how should a company safeguard itself in protecting its decision?
So when we talk about the Income Tax Act, when it talks about valuation, the entire the principles of valuation even here they refer to registered valuers also.
Yeah,
So that is one, and those registered valuers are the same if you look at the other laws also. For instance, the Insolvency and Bankruptcy Code. There also there is this concept of registered valuers and how it is valued. My suggestion would be for any company that ensure that you have a registered valuer on board. The other way of doing it is depending upon the size of the company, have two valuers.
Hmm.
Have two valuers who can do it, because then when you have the third contradictory valuation report, at least you have two valuations to show.
correct.
That is one. The other thing, what I believe, in when it comes to valuation, and there is so much which is talked about, and I don't think this is the best forum to mention those things, what is discussed with regard to valuation. But the point with valuation, what I feel is that it needs to be, there needs to be more audit on the kind of valuation which is being carried out. And companies, what happens is that companies trust outside people to do the valuation properly. But to avoid situations where there is a contradiction and which leads to a lot of disputes, for instance, from the income tax angle as well, have a more eyesight and overview and oversight basically over the valuation which is going on to ensure that it is fair and reasonable.
Yeah,
That is the way I think to mitigate these
correct.
problems.
Correct. Because now I think even the share issue, the gap, they have closed it. So even if it is a issue to a non-resident, now it has been plugged in with the amendment in the this current budget, that even if it is issued to non-resident also, this 756 to 7B still applies.
Yeah.
Yeah.
Okay. Anything else?
So, yes, sir.
Yeah.
So I didn't understand regarding that LLP. In the LLP, when you said that when capital asset is transferred from partner to the firm, then who is, I mean, taxed in that scenario? You said like in an LLP, when there is transfer of capital asset from partner to the firm, I mean, when there is contribution from the partner to the firm, then I mean, during the formation of the LLP and when partners are contributing, I mean, at that level also the LLP, is going to be taxed when they are contributing the capital gains.
It will be taxed at the hands of the partner, because the gain is for the partner. Actually, there is a entire calculation. If I show it to you with an example, then you'll understand that it is actually the partner who is gaining if there is a capital gains. So what we'll do is, if we can just circulate something after this class with an example, then you'll understand better that how it is a capital gain is at the hands of the partner, and that is why the partner has to be paid. Partner has to pay the income tax.
Okay, sir. Okay, and secondly, sir, how to quantify the intangible assets? I mean, if suppose the partnership or company, in a partnership, a person brings some intellectual property. In the yesterday's class, you said that you'll discuss this. Then how is there any formula in the Income Tax Act itself that how they will quantify it? I mean, if me as a partner of an LLP, I say that I'll bring some, intellectual property I'll bring that. So how to quantify it with respect to profit and loss and all that?
So intellectual property, basically it depends on, what is it that you're bringing in. And there is some complexity behind it. For instance, when you talk about, intellectual property, what practice is not to really, make it capitalize it as an asset. Because if you look at the definition of capital that we were discussing, and especially in the context of capital assets, it basically means property of any kind, whether fixed or circulating, movable or immovable, tangible or intangible. Over here, there is no really great reference which is given to intellectual property. What happens in those cases is that normally the practice is that there is something called an assignment of the property. The intellectual property is assigned. That way, people bring in intellectual property in the firm. And then there is some fee which is given to the partner who is bringing in the intellectual property. You
Okay,
understand?
sir.
So it is in practice, it
I
is
mean, yes,
capitalized
sir.
because of this confusion. What you just said, no, because of this confusion, that valuation of it's not that easy. How do you value something? That is that two interpretative difficulties. One is that will it fall under the definition of capital asset, which is there, and the other thing is this valuation. So that to avoid that confusion, people you normally assign the intellectual property, whatever is has to be assigned.
You mean like a partner assigns further assigns it to the LLP? That
Yes,
in
yes,
that sense?
yes, yes,
Okay,
yes.
okay, sir. Okay. Thank you.
Okay. All right then. Thank you.